There's always interesting companies and is always kind of the flavor of the day, but the way in which companies are getting funded, I mean, this topic is very different today than it was 10 years ago.
So how do you think the venture business has changed over the last, how long have you been in the business for?
10 years.
10 years. So,
yeah.
so talk about the evolution and how things have changed and the businesses you see today versus the businesses you saw back then.
Yeah, good question. I mean, you mentioned it a little bit in that you tend to, in tech and in venture, you tend to get waves of the same type of, companies. Obviously, 10 years ago, so social media hit the scene and everything was social media. Today, fintech is a very popular space. IoT is a massive space. And so those trends keep coming and going. What I do see today, and I'm going to answer it a little indirectly, is the market has changed. So companies, there's always interesting companies and is always kind of the flavor of the day, but the way in which companies are getting funded, I mean, this topic is very different today than it was 10 years ago. 10 years ago, you'd go out, you'd raise an angel round of maybe $1 million, then you'd raise a seed round of maybe another $1 million, and then you'd raise an A round, and if you're lucky, you'd raise $5 million in the A round. Today, we joke internally and we say, A is the new seed. There's companies out there with no products that are raising $10, $15 million. And then you go to the A round and there's companies that are raising $20 and $30 million. And that's, I could talk 40 minutes about this and I'm not going to, but that's a result of a massive amount of capital coming into the market in the last 4 years, the last 5 years. It has been a phenomenal time to start a business in the last 4 and 5 years. So if you've just come into the industry and this is your experience the last 4 and 5 years, unfortunately, I'm here to tell you that's not normal, right? It has been the heyday for entrepreneurs looking to raise capital. Are we going to go back to how, the life we lived in 2008 where there was no capital? I don't think that's the case. But everything is cyclical, and I do think that there's going to be a reversion back to the mean, and capital is going to be a little more scarce, and that's things that you guys need to think about. But that's the biggest difference I see in the market today is just that access to capital and how that's changing the way businesses are being funded and really the way businesses are being started.
That's a good point, and it does go in waves and cycles, and there's a lot more. We've seen a lot more entrants into the Canadian market. We've seen a lot more people interested in the business model because the software as a service business model is so new, and people realize how attractive the economics are, and the prices have ultimately gone up significantly since we started in the business, right? The other thing that's also interesting is the talent pool in Toronto has become so Damien talked about how great it is to start a business. One of the things that's so attractive right now is the talent is so deep in the Canadian market. I mean, I feel like I'm a kid in a candy store because when we're looking at a business and you want to go and hire a head of marketing or someone to run your marketing team, 4 or 5 years ago, there was no one to hire. And today, even though it is difficult, there's just the depth is there, the experience is there, and it's really, I think that's a very exciting time in the market. It is an exciting time in the market right now. The other thing that's changed over the, say, 10 years we've been investing is it took so long to build technology, and the companies were so technology focused. Now it's much easier to build the technology, and the companies are so marketing sales focused, and the way that we market and sell today is so different even than it was 5 years ago. And that's what a lot of our CEOs are saying. It's amazing. Some of them actually going back into sales and marketing in their roles to learn it again because it's changing so quickly.
It wasn't that long ago that you started a tech company. You had to build your own server farm. Like you have your own servers in your office. I mean, that's absurd today, right? So, the cost of starting a business has come way down. Canada continues to be a great place to start a business. Look at the programs that are available to startups today. We did the analysis at Omer's a couple months ago, and we figured, and this is rough stuff, but we figured it was the cost difference between hiring an engineer in the US versus Canada is about 3 to 1 today. So with net of all your R&D credits and all that jazz and exchange and all that, you can hire 3 dev for 1 in the US. I mean, that's a huge competitive advantage that didn't exist 10 years ago. there's been so many companies funded in the last 3 years that, I've got the data on this. If you look at a chart, if you compare 10 years ago to today, there are 10 times more companies have raised a seed round in 2015 than in 2005. 10 times more companies, okay? That same number for A rounds doubled. So what does that tell you? That tells you that the number of seed rounds that are being done has increased dramatically, yet the number of A rounds has only increased slightly. So that idea of a Series A crunch is very real. You used an A as an example, and I guess the crunch could come later. What do you do as an entrepreneur? I actually don't think down rounds are necessarily evil. I think if they're done in the right way, they can be healthy. It can be a reset on a cap table. You have to have the right type of investor. There was I forget who did it. It might have been Mark Suster that wrote a great blog last week actually on this very topic. And my advice isn't necessarily how to handle the down round. My advice is how to handle the A round to set yourself up so that if you do have that problem, you're better set to solve it. And one of the things I harp on entrepreneurs and investors for that matter is to keep things simple. Don't over-formulate your financing rounds because it just makes it more difficult later on. So, in that situation that you're explaining, if you had a simple cap structure and you come in and you go, you know what, we did our A round at 50 million valuation and now the company is only worth 40, so what? Everybody gets diluted a little bit. I will say investors hate down rounds, so it's more difficult, but that's it. I mean, there's no other secret math to it. There's nothing else that's going to happen to your business. It just makes it a little more difficult. But what my last comment, and I'll pass it to Danny, is, and this is hard sometimes to communicate and hard to hear. As an entrepreneur, when I have friends who quit their jobs to become CEOs, I have one piece of advice I always give them. Fail fast. If you're going to fail, fail fast. And what I mean by that is the worst case scenario is you spend 10 years and you have nothing at the end. So the reason I bring this up is in that case where you try and raise an A round and you may have a down round, I'd actually step back and go, okay, what am I missing here, right? And take a hard look at your business. Sometimes it's just a bad idea. Or sometimes it's not working. And sometimes you have to make changes along the way. So, the market speaks to you in different ways, and that's not to say that everybody who does a down round is a bad business. That's absolutely false. But, take those opportunities and really ask yourself, what am I doing, and is it still worth it? And if it is still worth it, then you take capital at whatever market rate it is, even if it is down round. I don't know, what do you think?
So I have a lot of thoughts on this. I mean, failing fast, I would say, we see so many examples of people that limp along for 10, 12 years and literally just waste their life limping along with a crappy business and going too long. On the flip side, it takes a long time to build a business. And if you go fail fast and spend too much money and be capital efficient, if you're going to fail fast, be capital efficient when you're failing fast, right? Because I could tell you so many of our companies, almost every one of my companies, and I'll just say in Klass portfolio, we wish we had those initial few million dollars back that we started off the businesses with, because we spent it on such junk that when you look back, whether it was consultants or whatever we used in the early stages, we wish that we had the capital today when the businesses are much more capital efficient and you could scale quicker. So that's one of the things when I look back, I think there are companies that we have that are doing awesome, but they used $3 million on nothing, and now they're sitting there with a great business, a great product scaling, and they don't have the $3 million. I would say raise more money than you need. Be very capital efficient. Don't get into the cycle. There are some venture funds out there, and this is their model. You go raise money, and it's always about raising more money and at higher and higher valuations so they can mark up their books. And to me, that's a very short-sighted approach to building a great business, and it's not the approach we like to take. When we give money to a business, we give money with the intention of giving money with a fully funded business plan. So if I was to raise money for my business, I would not raise money hoping that I'm going to raise money again. So give yourself the time and the options to do that.
A fundamental belief that everything is connected and will be connected. So playing on that IoT theme, I think, is very interesting. You know, there's lots of markets that are going to be very successful that I'm just frankly not interested in. So, you know, I think fintech is a very hot space today. I believe it will continue to be a hot space, but I believe there'll be I think there's been a lot of companies that have been started in the space, and I actually think that that number is going to shrink in the short term before it starts to grow again. I don't know if you jump in here.
Yeah, you know, I think we're in the golden age of software. So I think for the next 5 or 10 years, we are going to see this growth continue as we shift more and more to the SaaS market, and the incumbents, you know, like the IBMs of this world, try and keep up or make acquisitions. There's going to be a lot of acquisitions in the software as a service space. I also think things are moving so quickly, much quicker, and things are more disruptive than we've ever seen. You know, we even look at things like self-driving cars and think, can we invest in a company that provides software for parking, thinking about where that business will be 5 years from now, and thinking about the next person that will ultimately invest in that company. So things are moving quickly. I think we're in the golden age of software. I think a lot of these fintech companies think they're technology companies, but they're taking credit risk, and they have no underwriting expertise, and they're going to get their heads handed to them if they continue to act like technology. I think you're either a technology company or you're a bank, and I think bringing those together is a very difficult thing. I think there's a lot of underwriting risk that people don't realize that they're taking. And I also think that valuations today are not sustainable. I think they're too high, and there are too many people coming into the space, whether it's hedge funds and people that are not traditional investors coming into the space. And I think that's going to be a big issue in the next 3 to 5 years.
You know, I'm sitting here trying to think, to answer your question, I'm trying to step back and think broader instead of certain verticals. Like machine learning and AI, I think will have an impact on almost every vertical in technology. So, you know, think about that. If you're starting a new company, whether it's enterprise software or it's consumer technology, I do have a fundamental belief that you should be thinking about how machine learning and AI plays into that in the long term, because if you're not, somebody else will, and you'll be left in the dust. You know, something as simple as, I'd apply this to every one of our companies in our portfolio today. We're sitting around the boardroom table saying, hey, people solve these problems today. Computers may do it very soon.
And it's a great point. If you look at that macro with artificial intelligence, and it's hard to grasp what it really is, but so many people, I mean, for a long time, we're looking at analytics and saying what the company did and how it performed and looking at those metrics. I don't think that's the future. The future is going to be what you should be doing instead of actually saying what you did.
Predictive.
And it's going to be very predictive in terms of making decisions for you ahead of that to get the results that you want to get. And a lot of our software companies are thinking about that when it comes to learning, when it becomes, we have a company called 360 Incentives, that's all insights. Yeah. And they're even starting to think like that. Who wants a dashboard now and tell you what happened in the past? You want that dashboard to tell you what to do so you get the results that you want to get in the future.
The coolest thing I heard of today, just to give you a real life example of that, is a partner of mine has a Tesla. And so he comes home one day with his new Tesla, and I guess you can control, you know, the height of the car, and I guess he has a big curb. And so as he pulls up to his driveway, he slows down and he raises the car, and he goes into the driveway. The next time he came home, the car did it itself. Like, think about that. Like, so you should no longer be asking questions. You should be provided answers before you even ask the question. Why ask a question twice? Why make a command twice in any of your businesses that you have? Technology exists today that can do that automatically, and we should be thinking about how to build that in.